This module focuses on accounting and financial reporting as tools for financial control. The budget serves also as a mechanism for achieving financial control, and we've discussed this role in the last module when we focused on budget implementation and execution. As was discussed in the module on budget execution and implementation, the budget document provides the foundation for financial control. Budget authority then dictates what, how, and when resources can be used. Accounting and financial reporting are two other mechanisms through which we achieve financial control. The accounting system provides the record-keeping framework where authorized transactions are logged as they occur, as they take place. Financial reporting involves summarizing the accounting information into a format that is useful for oversight and for monitoring. So, for example, a quarterly interim report may provide information needed for determining how closely revenues are matching the revenue projections. Combined, both accounting and financial reporting provide information about the government's financial position at any given time. For example, we can use information from the accounting system and summarize or aggregate it into a financial report to track how much money has been spent, what it has been spent on, what revenues have been received, and from what sources. As a result, the accounting system is useful in identifying trouble areas. For example, where spending is becoming out of control or where revenue lags expectations. They are also important budget control tools because they offer the mechanism to track revenues and expenditures against the budget as it's being implemented. So, to serve all of these functions, the accounting must be accurate, it must be understandable, reliable, relevant, comparable, consistent, and timely. Financial reports must also be timely to allow for the tracking of revenues and expenditures against the budget as is implemented. This chart shows the timeline and events that link the budget, the accounting system, and financial reporting. The adoption of the budget is the first step, and this adopted budget sets the standards for financial and budgetary control. Once the fiscal year begins, budget authority commences and transactions occur. These transactions can include tax revenues received, payroll checks issued, payments made, fund transfers made, and the like. As these transactions take place, they are logged chronologically into the accounting system. Interim financial reports are prepared, and these interim reports, as we talked about last module, can be on a monthly, quarterly, or semi-annually basis, and the reports provide aggregated and summarized information from the accounting system. At the close of the fiscal year, budget authority ends, and the information from the accounting system is aggregated and summarized to provide a report for the entire fiscal year. This report is called the Comprehensive Annual Financial Report, or the CAFR. While the budget and the accounting system and financial reporting system, they all work in tandem, there are tensions that exist between the three. First, budgeting involves revenues and expenditures, while accounting and reporting typically focus on assets and liability. This is because there are different assumptions underlying the budget and there are different standards that guide accounting and reporting. The budget is designed and structured to reflect the government's need to meet the legal obligations that are incurred during that budget period or during the fiscal year. The accounting and reporting, in contrast, focus more on economic and/or financial conditions. This is what's reflected when the accounting and financial reporting systems focus on current assets and current liabilities, or current and fixed assets compared to current and long-term liabilities. The implication of this is that the totals that are shown in the budget and the information that is shown in the financial reports may be different, even for the same fiscal year. A second tension stems from the different bases of accounting that are used for the budget compared to accounting and reporting. The budget uses a cash basis, while accounting and reporting use an accrual basis. Furthermore, depending on the types of funds, so the general fund and other governmental funds, as opposed to proprietary funds or fiduciary funds, based on the different types of funds, the modified accrual basis or the accrual basis might be used. Specifically, the modified accrual basis would apply to governmental funds. So, for example, the general fund, special revenue funds, capital projects funds, and the accrual basis would apply to proprietary and fiduciary funds. You may be asking, how are these accounting bases different? The chart on this slide provides an easy way to understand the differences between the cash basis, the modified accrual basis, and the accrual basis. The cash basis, which applies to the budget, recognizes revenues and expenditures when the money is actually received or when it's actually spent. For example, when library fines are paid by patrons and received by library staff, or when payment is made for the purchase of new books for the library. At the other end, the accrual basis recognizes a transaction when the legal obligations are incurred. For example, the revenue would be recognized when the water utility sends the customer the water bill, even if the bill has not been paid by the customer or funds have not been received by the government agency. Similarly, the expenditure would be recognized when the water utility purchases a new computer, say by signing a lease agreement, even if the actual payment for the computer has not been made and the computer has not been received. Modified accrual is a hybrid between both the accrual basis and the cash basis. Revenues are recognized when the monies are actually received, but expenditures are recognized when the obligation is incurred. The accounting system is a key element of the budget execution and implementation phase. This is because the accounting system allows for tracking of actual revenues and expenditures to compare to projected revenues and expenditures. The accounting revolves recording all financial transactions according to very precise and specific rules. These rules ensure consistency across governments and across time. So, while the budget document has no standardized format and can therefore vary across different governments, and for the same government can be different over time, the accounting system and the financial reports that result from this system follow a set standard that ensures the information is comparable across different governmental entities and, for the same government entity, consistent or comparable across time. The rules that dictate the accounting system is called Generally Accepted Accounting Principles, or GAAP. The overall purpose of accounting is to maintain honesty and integrity. This has to do both with control, what we talked about in the last module, and with providing information. From a control perspective, the accounting system is focused on deterring fraud and corruption and preventing inadvertent loss. The purpose is to control agencies so they act in accordance with policy and administrative directives and the appropriation legislation. From an information perspective, the accounting system is designed to provide complete, timely, and accurate information concerning revenue receipts and expenditures. Some of the purposes as they relate to this information needs are: first, providing historical data on revenues and expenditures. Second, maybe providing information that's needed to assess the efficiency and the effectiveness in delivering services. Information needs might also be related to information needed to communicate between government and its citizens, investors, and other governmental entities. To provide information needed to identify financial condition or fiscal health of the government, or also maybe to report on the management of funds that are held in custody or in trust. The accounting system is used to generate financial reports. These reports can take the form of interim reports, which are part of the budget execution phase, or annual reports, which are part of the audit and evaluation phase of the budget process. The interim reports can be generated on a schedule, so for example, monthly or quarterly, or on an ad hoc basis as needed by the management team. The annual report, on the other hand, covers the entire fiscal year. As will be discussed shortly, the interim reports are management tools, while the annual report is a tool for accountability. The preparation of these interim and annual reports represents the culmination of financial control in the budget process. So while the budget is the preeminent financial document, financial reports play a very important role as well. These roles include, for example, alerting stakeholders to impending financial problems. For example, will we run out of money before the end of the fiscal year? Or has the increase in fuel prices caused a substantial problem for cost control? But financial reports also play a role in verifying to the external stakeholders that the government entity has control of its finances and is capable of adapting to changing circumstances. As I mentioned in the previous slide, there are two types of reports. The interim reports, which are periodic reports that serve internal purposes, and annual reports, which are issued on an annual basis. For interim reporting, periodic reports may be issued weekly, monthly, or quarterly and are intended for managerial or internal audiences. Examples of interim reporting may include checking on appropriated funds that are unspent, or tracking actual revenues against projected revenues. As these examples illustrate, interim reporting is useful in monitoring budget execution and anticipating situations in which agencies might lack sufficient funds to operate their programs throughout the fiscal year. Let's now turn to the annual report. While interim reporting takes place during budget execution, annual reporting takes place at the conclusion of the fiscal year, during the audit and evaluation phase. For state and local governments, the annual report takes the form of the Comprehensive Annual Financial Report, or CAFR. Unlike interim reports, these annual reports are prepared for external constituents, people or organizations outside of the government. For example, the CAFR shows taxpayers how revenues have been used to provide services. It also provides information for businesses considering locating, relocating, or expanding their existing facilities. The CAFR may also provide information for determining the financial condition of governments and deciding whether to purchase their bonds. It's important to note that this is a very short, abbreviated discussion of the CAFR. We will revisit this conversation about CAFR when we talk about the group project that involves financial condition analysis.